very much, Gugletu. I think that felt like a A plus. His Excellency, Ban Ki-moon, honorable finance ministers, central bank governors, and deputy governors, excellencies, distinguished guests, colleagues, ladies and gentlemen, good morning. On behalf of the Standard Bank Group, it is my great privilege to welcome you to the 2026 African Market Conference here at the Novell Foundation Art Museum in Cape Town. And what an incredible venue this is. In less than a decade, this space has helped reposition Africa contemporary art from the margins of the center to that of the global conversation. This foundation represents infrastructure catching up with talent. And it's an apt venue for us to be hosting our second AMC conference out of Cape Town. The objective of our gathering is straightforward yet ambitious: to facilitate solutions to how global capital can be mobilized at scale to support Africa's structural transformation. The global environment is undergoing material change. Geopolitical fragmentation, heightened macroeconomic volatility, and shifting trade alignments have increased the selectivity of cross-border capital flows. Risk pricing has become more pronounced. Development finance has become more constrained. Capital allocation decisions are increasingly influenced by regulatory complexity, fiscal credibility, and institutional strength. At the same time, Africa's structural requirements continue to intensify. Rapid demographic expansion, accelerating urbanization, rising energy demand, and the need for resilient infrastructure continue to expand the continent's financing requirements. The central question, therefore, before us is not whether capital exists, which it does. The question is whether the African markets can consistently access this capital at scale, at an appropriate cost, and with sufficient depth to sustain long-term growth. Our theme this year of mobilizing capital at scale reflects a structural shift in focus. Scale is not about increasing the number of transactions. It is about building markets that can access capital consistently, at volume, and at competitive cost. It is about the liquidity, standardization, and predictability, the conditions that allow institutional capital to allocate with confidence. In practical terms, this means moving from isolated bespoke transactions to investable pipelines supported by credible policy frameworks. It means shifting from Africa as a tactical trade to Africa as a strategic long-term portfolio allocation. That shift will not occur through optimism alone. It requires disciplined fiscal management, transparent regulation, credible debt frameworks, robust project preparation, and deeper domestic capital markets capable of absorbing and recycling capital efficiently. Mobilizing capital at scale is therefore not principally a question of global liquidity. It is a question of market design and institutional execution. There are several structural factors that support confidence in Africa's long-term investment thesis. And some of these are: firstly, domestic capital formation on the continent is significant. Estimates by the African Finance Corporation suggest that Africa holds approximately $4 trillion in domestic investable capital. Pension funds, insurance assets, sovereign funds, and banks like ourselves collectively represent a substantial pool of liquidity. However, mobilization remains uneven due to regulatory constraints, limited secondary market depth, and project preparation bottlenecks. Secondly, the infrastructure financing gap, estimated at between $130 to $170 billion per year. This represents both a developmental constraint and an investable opportunity set. transport corridors, power generation and transmission, water systems, digital networks, and logistic infrastructure can generate long duration cash flows aligned with institutional investor mandates. Thirdly, capital flows are highly responsive to policy credibility. Empirical evidence demonstrates that the consistent fiscal frameworks, transparent debt management practices, independent monetary policy, and reliable regulatory enforcement materially reduce sovereign and project level risk premium. The implication, therefore, is clear. The mobilization challenge is less about the global supply of capital and more about the quality of market architecture through which that capital is deployed. Last year, the inaugural African Markets Conference demonstrated that structured engagement between issuers, investors, and policymakers can produce tangible outcomes. As an example, the collaboration between BNY, previously known as Bank of New York Mellon, on global depository notes referencing Nigerian securities broadened investor access to local instruments. Engagement with sovereign issuers contributed to renewed international market participation, including structured investor outreach initiatives. The purpose of this AMC is to build institutional continuity. Capital markets develop through sustained engagement, regulatory clarity, and credible signaling, and not through singular events. Allow me, therefore, to outline the role we believe that the Standard Bank Group, and in particular, the Corporate and Investment Bank, must play in this process. Standard Bank is an African institution with global connectivity. Our CIB franchise operates the intersection of policy formulation, capital allocation, and transactional execution. We integrate our solutions within a unified platform. And this integration enables the structuring of sovereign and corporate financing solutions, the provision of risk management instruments, and the facilitation of cross-border trade and payments within a coherent institutional framework. Our scale is material. We maintain an on-the-ground presence in 21 African markets linked to major global financial centers. We hold approximately 1.1 trillion rands in deposits and distribute more than 650 billion rand in advances every year. Within CIB, we serve over 3,000 clients and process an average of nearly 5 trillion rand in payments daily. In 2024, our CIB franchise generated 65 billion rand in revenue, reflecting resilience across market cycles. However, scale is not alone sufficient. The strategic imperative is to deepen market liquidity, broaden investor participation, and strengthen the structural underpinnings of capital markets across jurisdictions. Africa does not require isolated flagship transactions. It requires deep, transparent, and functioning markets. Over the next 2 days, discussions will focus on 4 structural shifts necessary to mobilize capital at scale, in our belief. First, from risk perception to risk differentiation. Risk cannot be eliminated, however, more granular data, improved disclosure standards, and consistent policy communication allow investors to differentiate rather than generalize, thereby narrowing the risk premium. Second, from conceptual projects to bankable assets. Project preparation facilities, credible procurement processes, enforceable contracts, and governance discipline are prerequisites for institutional capital participation. Third, from single source financing to layered capital structures. Blended finance mechanisms, credit enhancement instruments, political risk insurance, and developmental finance participation can de-risk projects sufficiently to crowd in pension and insurance capital at scale. Fourth, from fragmented domestic markets to integrated regional capital markets. Liquidity, harmonized regulation, cross-border settlement efficiency, and digital infrastructure are foundational to capital markets deepening. Regional integration, including through the AFC FTA, enhances market size and resilience. The AMC 26 program reflects these priorities. These are not theoretical discussions, they are operational questions that determine capital allocation outcomes. Ladies and gentlemen, in conclusion, Africa's development trajectory will be shaped by the strength of its institutions, the credibility of its policy frameworks, and the depth of its markets. Natural resources and demographic growth create potential. The strength of institutions determine whether that potential is realized. This conference is therefore focused on practical objective, strengthening the market architecture that enables capital to flow efficiently, predictably, and at scale. Regulatory coherence, discipline, fiscal management, transparent debt frameworks, and robust capital market infrastructure are not abstract principles. They are the foundations upon which sustainable growth is built. If we advance these foundations with consistency and discipline, the result will be deeper and more resilient African markets. Markets capable of mobilizing domestic savings, attracting long-term global institutional investors, and financing structural development on sustainable and competitive terms. At Standard Bank, we remain committed to partnering with governments, regulators, investors, and multilateral institutions to strengthen these markets. Because Africa is our home and we are committed to driving a growth through disciplined deployment of capital. Thank you, and I wish all of you a very productive Africa Markets Conference 2026. And I hand over back to Gugulethu. Thank you very much.